In 2001, one of America's largest corporations collapsed almost overnight. In 2008, a man who promised steady returns erased over $60 billion. In 2022, a crypto empire vaporized billions in customer funds within days. Different decades, different industries, the same pattern. These are some of the biggest financial scams in history and the systemic failures that allowed them to happen. We'll examine each case, looking at the spectacular rise, the grand illusion, the fraud itself, the collapse, the governance failure, and the hard-earned lesson for every investor. Let's start with number 5, Wirecard and Germany's phantom billions. Founded in 1999, Wirecard positioned itself as Europe's answer to PayPal, and for a while, it seemed like they had made it. By 2018, its valuation topped 24 billion euros. It was listed on Germany's prestigious DAX index and celebrated as a fintech success story, a true symbol of modern European innovation. The illusion was built on a story of massive growth in Asia. Revenue projections soared, and investors eagerly bought into the expansion narrative. But investigative journalists from the Financial Times started noticing strange inconsistencies in the company's books. Here's how the fraud worked. Wirecard reported that 1.9 billion euros in cash was being held in trustee accounts in the Philippines. When auditors finally tried to verify these balances, the banks told them a shocking truth. The money did not exist. It had never existed. The company had allegedly been inflating its revenues for years using a shadowy network of third-party partner entities. The collapse was swift and brutal. In June 2020, Wirecard finally admitted the 1.9 billion euros were missing. Within days, the stock collapsed. The CEO, Marcus Brown, resigned, and the company filed for insolvency, becoming one of Europe's largest accounting scandals. The governance failure was total. Weak board oversight, complacent regulators, and an aggressive campaign to dismiss critics and short sellers instead of investigating their claims. Germany's own financial regulator even targeted the critics instead of probing the company. The lesson here is critical. When a company grows rapidly but resists transparency, skepticism isn't negativity, it's discipline. Next up, number 4, Theranos, the ultimate Silicon Valley illusion. Founded in 2003 by a charismatic Elizabeth Holmes, the promise was revolutionary. Perform hundreds of blood tests from a single drop of blood. By 2014, the company was valued at an incredible $9 billion, backed by political elites, with Holmes being hailed as the next Steve Jobs. The illusion was the technology itself. The company claimed its proprietary Edison machines could do the impossible. In reality, the machines frequently failed. To cover it up, they secretly used traditional, commercially available equipment for their tests. Employees who raised concerns were ignored, and whistleblowers were silenced. The fraud mechanism was simple misrepresentation. Theranos lied about the accuracy of its technology, its readiness for commercial use, and its internal validation data. Investors were shown carefully staged demonstrations that hid the truth. The eventual collapse came after brave investigative reporting exposed the entire charade. Regulators intervened, partnerships dissolved, and Elizabeth Holmes was later convicted on multiple fraud charges. The governance failure at Theranos was a textbook case. The board lacked any real medical or biotech expertise. It was stacked with famous political figures instead of scientists who could ask the tough questions. They completely failed to demand independent validation of the technology. The lesson is powerful. Charisma is not a substitute for due diligence. Coming in at number 3, FTX, the crypto empire that imploded. Founded in just 2019, FTX rocketed to become one of the world's largest crypto exchanges, hitting a staggering valuation of $32 billion at its peak. It was backed by major venture capital, and its founder, Sam Bankman-Fried, presented himself as the responsible adult in the crypto world. On the surface, FTX looked stable, risk-managed, and transparent. But behind this carefully crafted image, customer funds were allegedly being funneled to its sister trading firm, Alameda Research, creating extreme hidden risk. Customer deposits were reportedly used to cover massive trading losses, all hidden by opaque balance sheets and virtually non-existent internal controls. When a liquidity crisis hit in November 2022, a run on the exchange exposed the house of cards. Within days, billions were withdrawn. The exchange froze withdrawals, and the company filed for bankruptcy. It was a catastrophic failure of governance, with no proper board or financial oversight. The lesson? Transparency vanishes when things get volatile. The foundation was never strong to begin with. Next, at number 2, we have Enron, a masterclass in accounting engineering. Enron was once the 7th largest company in America, reporting over $100 billion in revenue in 2000. It was celebrated for its innovation in energy trading. But the innovation was an illusion. Enron aggressively used mark-to-market accounting to book projected future profits as current income. It also created special entities to hide mountains of debt, making its financial statements nearly impossible to understand. This mechanism allowed Enron to move losses off its books and invent artificial profits to inflate its stock price. As the stock soared, executives quietly sold their shares. But in late 2001, the truth unraveled. Confidence evaporated, and the stock price plummeted from $90 to less than $1. Employees lost their pensions, and its auditor, Arthur Andersen, dissolved. The board had approved complex structures without real scrutiny, and executive pay was tied directly to the inflated stock price. The investor lesson here is crucial. If you can't understand the financial structure, you can't possibly price the risk. And finally, at number 1, Bernie Madoff and the largest Ponzi scheme in history. Madoff, a former NASDAQ chairman, was a trusted figure on Wall Street. For decades, he promised and delivered steady returns of 10 to 12% a year, and investors flocked to him. The illusion was in the consistency. His returns never wavered, even in volatile markets, but his investment strategy was always kept deliberately vague. The mechanism was a classic Ponzi scheme. Money from new investors was simply used to pay off earlier ones. There was no real investment strategy. The scheme ballooned to over $60 billion in losses. When the 2008 financial crisis hit, a surge in redemption requests caused the entire system to collapse. Madoff was arrested and sentenced to 150 years in prison. This was a massive failure of regulatory oversight, fueled by an over-reliance on reputation. So, what's the bigger pattern here? Across all these cases, complex structures were used to hide simple fraud. Authority and reputation were used to discourage skepticism, and rapid growth suppressed any doubts. In every decade, markets produce innovation, but they also produce illusion. The question isn't whether another financial scandal will happen. It's whether we'll recognize the warning signs before it's too late. Thanks for watching.